You know one. The person at the office who never talks about money, never posts a vacation photo with a caption about treating myself, never asks to split the bill down to the last cent. Nobody notices this person. That's the whole point. While everyone else is comparing new cars in the parking lot or debating which credit card gives the best points, this person is running 15 accounts that most Americans have never opened. Not because they're complicated, but because they're boring. And boring, it turns out, is where the money actually lives, quietly, while everyone else is looking somewhere louder. Take Nathan, 41 years old, drives a 2016 Corolla, orders the same coffee every morning, and has never once mentioned his finances at a team lunch. Nobody at his office knows his accounts are worth $480,000. Not because he got lucky. Because he opened 15 accounts most people skip and let them sit there, untouched, for years. Here's what's strange about that number. Nathan doesn't earn more than his coworkers. He earns about the same. $73,000 a year. Sit him next to a coworker making the exact same salary, same title, same years at the company, and on paper, nothing separates them. One drives the same Corolla for 11 years without a single complaint about it. The other leases a brand new SUV every 3 years, always talking about the upgrade. One has $480,000 quietly compounding. The other has a car payment, a lease renewal every 3 years, and a checking account that resets to zero every 2 weeks. The difference isn't the paycheck. It's what happens to the paycheck after it lands. And that difference comes down to 15 accounts. Not one magic account. Not a single genius move. 15 separate, unglamorous decisions, most of which take under 15 minutes to make and then require nothing further. No daily check-ins, no trading, no watching the news for the right moment. Some you've heard of and ignored. Some you've never heard of at all. Every one of them is boring enough that nobody would ever brag about it at a dinner table. And every one of them is doing real work in the background, right now, whether you're watching or not. Stick around, because by the third one, you'll probably realize you're already sitting on money you forgot existed. The first one everyone technically has and almost nobody uses correctly is the 401k, specifically the employer match. It costs nothing extra beyond what you're already earning. If your company matches 50 cents on the dollar up to 6%, and you're only contributing 3%, you are walking past free money every single paycheck, twice a month, without noticing. On a $73,000 salary, that unclaimed match is worth roughly $1,095 a year. Money nobody has to work for, sitting there uncollected because a form never got updated. Over 30 years, invested and compounding, that ignored match alone can grow past $200,000. Most people skip it because the form to increase contributions takes 4 minutes and feels like a hassle on a Tuesday afternoon, easy to put off until later. Fixing it takes less time than the commute home. Log into the benefits portal, raise the contribution to the full match percentage, and never touch it again. The second account is the Roth IRA. $7,000 a year, contributed with money you've already paid tax on, so it grows completely untouched by the IRS for the rest of your life. No tax on the growth. No tax on the withdrawal at retirement. Put in $7,000 a year, starting at 30, get the historical S&P 500 average of 10.5%, and by 65, that account alone holds roughly $2,100,000, tax-free, every dollar. Wait until 40 to start the same habit, and the total drops to around $700,000. Same $7,000 a year. The only difference is when the clock started. People skip it because $7,000 sounds like a lot as one lump sum. Split monthly, it's $583, less than most people's car payment and less than what the average household spends on groceries. Opening one takes 15 minutes at any major brokerage, no employer required. Third is the health savings account. Technically for medical bills, actually one of the best retirement accounts in the entire tax code. Triple tax advantage. Contributions go in tax-free, growth is tax-free, and withdrawals for medical expenses are tax-free. And after 65, you can withdraw for anything, taxed like a regular retirement account, no penalty. Max it at $4,300 a year for a decade. Invest it instead of spending it, and it can grow into 6 figures nobody's tracking, sitting quietly next to accounts people actually check. People skip it because they treat it like a checking account for pharmacy visits instead of a second retirement account, draining it every time a copay shows up. The fix? Pay small medical bills out of pocket when you can afford to, keep the receipts, and let the HSA invest untouched church for decades. Now here's where it gets interesting. The next one is the account most Americans have never even heard of, and it's backed by the US government itself. Before the next one, consider two coworkers hired the same year, same department, same $73,000 salary. One treats the HSA like a pharmacy card, draining it every March for allergy medication and a dentist copay. The other pays those same small bills out of pocket and lets the HSA sit invested, untouched, for 11 years straight. Same salary, same benefits package, same open enrollment form every October. By year 11, one account has roughly $4,000 left in it. The other has grown past $60,000. Nobody in that office could tell you which coworker is which, because neither one ever brings it up. There's a reason none of this shows up on a phone screen the way a stock pick does. Financial media makes money from attention, and boring doesn't hold attention. A chart that goes up 10% overnight gets clicks. A savings account earning 4.5% quietly does not. So the accounts that actually build wealth for most people get almost no coverage, while the ones that occasionally make someone rich overnight, and far more often don't, get entire channels built around them. The 15 accounts on this list will never trend. That's not a flaw. That's closer to the reason they work at all. Nobody's crowding into them. Nobody's panic selling them during a bad news cycle. Nobody's treating them like entertainment. Fourth, the backdoor Roth IRA, for anyone who earns too much to contribute to a regular Roth directly. It costs nothing but 2 extra steps. Contribute to a traditional IRA, then convert it to a Roth within days, before any real growth happens inside it. Same $7,000 limit, same tax-free growth, same 7-figure potential by retirement. Just reach through a side door instead of the front one. High earners skip it because it sounds like a loophole for accountants, not regular people, something that surely requires a lawyer or a call to the IRS. It isn't. Most major brokerages walk you through the conversion in under 10 minutes, with a screen that basically does the paperwork for you, and it's completely legal, documented, and used by financial advisors themselves for their own money. Fifth, Series I savings bonds, bought directly from the U.S. Treasury. They cost as little as $25, adjust with inflation twice a year, and are backed by the federal government, meaning the value doesn't drop when the market does, even during a downturn that wipes out a chunk of everyone else's portfolio. A family can put $10,000 a year into them and let inflation-protected interest build quietly, completely separate from stock market swings. The kind of account that just sits there, unglamorous, while everyone else refreshes their brokerage app. People skip them because they don't sound exciting. No app, no chart, no notifications, nothing to screenshot. Opening an account takes 10 minutes directly through the Treasury's website, and the money sits there working while everyone else watches their portfolio bounce around. Most people stop paying attention around here. The ones who don't are the ones whose numbers look different 10 years from now. Sixth, the SEP IRA, for anyone with even a small side income. It costs whatever percentage of self-employment income you choose to set aside, up to 25% of net earnings, decided fresh every year depending on how the side work went. Someone earning $15,000 a year from freelance work could shelter close to $3,750 of it, tax-deferred, in an account most side hustlers have never opened, let alone heard of. People skip it because side income doesn't feel like a real business, so it doesn't occur to them they qualify. It feels more like extra money than income that needs a strategy. Any brokerage can open one in a single sitting. No accountant, no separate company required, no minimum income threshold to clear first. Seventh, the solo 401k, one step up from the SEP, for the same side income but with a higher ceiling. It allows contributions both as the employee and the employer side of the account, which can mean sheltering close to $23,000 a year even on modest freelance earnings, far more than the SEP allows at the same income level. People skip it because the paperwork sounds intimidating. Words like plan document scare people away before they even try. It isn't complicated in practice. Most online brokerages now set one up in about 20 minutes, and once it's open, contributing is no different than a regular IRA. Can you guess what the next one has in common with a college fund nobody ended up using? Most people assume that money is just gone. It isn't. Eighth, the plain taxable brokerage account, the least exciting account on this list and arguably the most important. No tax advantage, no contribution limit, just a place to put $300 a month into an S&P 500 index fund and leave it alone. At 10.5% average return, $300 a month from age 30 becomes roughly $955,000 by 65. Without a single trade, without any strategy beyond patience, without ever checking the balance more than once a year. Compare that to someone who keeps the same $300 a month sitting in checking, meaning to invest it eventually. Same income, same intention. 35 years later, one has close to $1 million and the other has whatever's left after groceries. People skip the brokerage account because it feels less official than a retirement account, so the money drifts into checking instead, one small purchase at a time. Setting one up takes the same 15 minutes as any other brokerage account. The only difference is deciding to actually use it. Notice something about the last 5 accounts. None of them involved picking a winning stock. None of them involved timing a market drop or catching a trend early. Every single one was a decision made once. A form filled out, a checkbox flipped, a percentage adjusted, and then never touched again for years. That's the entire mechanism behind almost every quiet retirement account on this list. Not genius, repetition, applied to something boring enough that quitting never crosses anyone's mind. Ninth, the 529 education account, which used to be limited strictly to school costs and now, under recent rule changes, allows up to $35,000 to roll directly into a Roth IRA for the account's beneficiary if it's never spent on education. That turns a leftover college fund, the one sitting there since a kid decided not to go the traditional route, or got a scholarship, or finished with money left over, into a head start on retirement instead of a wasted account nobody wants to touch. People skip it because they assume unused 529 money is stuck or penalized, a rule that used to be true and no longer is. A quick call to the account provider confirms eligibility and starts the rollover, usually with less paperwork than opening a new account from scratch. 10th, the target date fund, the account version of setting the thermostat and walking away. Pick the fund labeled closest to your retirement year, and it automatically shifts from riskier investments to safer ones as you age, without a single manual adjustment, without you ever logging in to rebalance anything. It costs nothing extra beyond the fund's small expense ratio, usually well under 0.5%. People skip it because it feels too simple to trust. Surely something that requires 0 decisions can't actually work. It's often the exact fund already sitting inside the 401k they have, one drop-down menu away, ignored in favor of picking individual funds nobody fully understands. The next one on this list is the one nobody talks about, because it involves admitting they forgot something. 11th, the rollover IRA for every old 401k sitting forgotten at a previous employer. The average person changes jobs multiple times before retirement, and each time, a small account gets left behind, often in outdated, higher-fee investments nobody's monitoring anymore. Some people have 3 or 4 of these scattered across old employers, each one quietly losing ground to fees while the owner forgets the login even exists. Rolling it into a single IRA costs nothing and takes about the same effort as a phone call. People skip it because dealing with it later becomes 5 years, then 10, then an account they can barely remember opening. One consolidated account is easier to manage, cheaper to hold, and stops quietly leaking money to fees nobody's checking. 12th, Treasury inflation-protected securities, or TIPS, bonds that adjust their value directly with inflation so the purchasing power of the money doesn't erode over decades, unlike cash sitting in a checking account slowly losing value every year prices rise. They cost the price of any bond purchase and can be bought directly through a brokerage or treasury account with no special approval needed. People skip them because bonds sound like something for someone already retired, not someone in their 30s. A mental category error more than an actual reason. But a small allocation protects the rest of the portfolio when inflation runs hot. The way a seatbelt doesn't do anything most days and matters enormously on the one day it does. Buying a few $1,000s worth takes the same steps as any other treasury purchase. 13th, dividend reinvestment, or a DRIP account, which automatically uses every dividend payout to buy more shares instead of sending cash to a checking account where it quietly disappears into everyday spending. It costs nothing beyond the shares you already own, and compounds quietly. A $50,000 dividend portfolio reinvesting at just 3% yield adds roughly $1,500 worth of new shares a year, without a single manual purchase, without a decision to make. People skip it because the checkbox is easy to miss when opening an account, buried in a settings menu nobody scrolls to the bottom of. Flipping it on takes about 30 seconds in account settings, and every future dividend does the work automatically, forever, until someone turns it off. 14th, the employee stock purchase plan, offered by many public companies and often ignored on the benefits page. It lets employees buy company stock at a discount, sometimes 15% below market price, straight from payroll deductions, before it even hits the checking account. On a modest $200 a month contribution, that discount alone is worth $360 a year before any stock gain, a guaranteed return most investments can't touch. People skip it because the enrollment window is easy to miss during onboarding, buried under insurance forms and a dozen other things to sign in the first week. Checking the benefits portal for this option takes 5 minutes, and, unlike most accounts on this list, it's money left behind simply by not reading the fine print. Here's the one most people think they're already handling correctly. They're not. 15th, and the one most people already have without using correctly: the high-yield savings account. At 4.5% APY, an emergency fund of $15,000 earns close to $675 a year just sitting there, doing nothing but existing. Most Americans still keep that same money in a regular checking account, earning close to zero, sometimes for years, without ever comparing the two numbers side by side. People skip the upgrade because moving money between banks sounds like a hassle worth avoiding, even though it takes about 10 minutes online and most transfers finish within a day or two. After that, every dollar sitting in savings quietly earns 45 times more than it did the day before. The easiest 15th item on this entire list, and often the very first one anyone reading this could open tonight, before doing anything else on it. None of these 15 accounts require a finance degree. None of them require 6 figures to start. What they require is doing the boring, unremarkable thing on a random Tuesday instead of waiting for a perfect moment that never quite arrives. Rebecca, 52, didn't open all 15 at once. She opened one a month for over a year, starting with the 401k match she'd been leaving on the table for a decade, then the Roth, then the HSA, working down the list in order, never rushing, never skipping a month, treating it like a recurring calendar reminder instead of a financial overhaul. Some months the account she opened held $25. Some months it held the full contribution limit, whatever that particular account allowed that year. The amount mattered less than the habit of not skipping the month. By the time she'd worked through the list, her combined accounts had grown past $610,000, and not one coworker at her office had any idea, because she never mentioned it. Not once. Not even when someone complained about their own empty savings account 2 desks away. That's the actual pattern behind every quiet millionaire nobody notices at the office. Not a secret stock tip. Not a windfall. Not a lucky trade someone whispered about in the break room. 15 ordinary accounts, opened one at a time, left alone to do what compound growth has always done when nobody's checking on it every day. Not a strategy anyone will ever post about, because there's nothing to post. No screenshot of a rocket ship chart, no dramatic before and after, just a slow, unremarkable line moving up and to the right for 30 years, quarter after quarter, statement after statement. Nobody but the account holder ever opens, while the account holder goes about an entirely ordinary life, packing the same lunch, driving the same car, saying nothing about any of it. This works whether the paycheck is $38,000 a year or $130,000. The dollar amounts on this list scale down easily. $100 a month into a Roth instead of $583, a smaller HSA contribution, an I bond bought with $25 instead of $1,000. What doesn't scale down is the decision itself. Opening the account is the same 15 minutes, regardless of income. The only variable that actually matters is whether it gets opened this month or gets pushed to someday. And someday, for most people, quietly turns into never. Here's the next step, and it's smaller than it probably sounds right now. Pick one account from this list. Just one. The account you don't already have. Open it this week, before the next paycheck lands, before the excuse about being too busy right now has time to fully form and take hold. Not the whole list, not a spreadsheet with 15 tabs and a color-coded plan. One account. The version of you 5 years from now isn't built by the flashy move everyone talks about at dinner. It's built by the boring one nobody ever notices, including, for a while, you.